Hey. My guest today is Raghav Kapoor, CEO and co-founder of Smartkarma. As CEO, Raghav drives product strategy, oversees tech development, and maintains a hands-on approach in the company's day-to-day operations. But with Smartkarma overall, Raghav has set out to reinvent how investment research is sourced, priced, and distributed. So for today's conversation, we cover the startup story of Smartkarma, the challenges of being an investment research platform, and what the future may look like at Smartkarma. So I learned a ton, you're going to learn a ton. This episode's a banger. Please enjoy my conversation with Raghav Kapoor. So Raghav, thank you so much for coming on today. And maybe just for guests who might be new to you and your work, and for some clarification before we go deep into the weeds, could you explain a bit about both your background and then where Smartkarma is today? Because I think hopefully during the conversation we'll fill in the middle there. So yeah.
Sure. So my background's very confused. I grew up in India till I was 15, 16 years old. Then I was in boarding school in Singapore, went to university in the UK, grad school in the US, worked in Europe for a while. And then around 2006, I sort of came back to Asia in between Singapore and Hong Kong and sort of started building most of my career here in Asia. More in terms of sort of my education, I'm a math and computer science major. I enjoyed all the non-CSE stuff. I was into numerical analysis, optimization. I did my dissertation on option pricing. So I was very much on the applied math, but sort of more theoretical side of things. I started off my career as a management consultant with a firm called Oliver Wyman in London. So I did the usual 2-year track with them, and I was starting to miss home and Asia and friends and so forth, and I wanted to move back here. And around the same time as I was making these applications while sitting in London, this was the booming mid-2000s, hedge funds were hiring, markets were strong. So I sent in my CVs to a few hedge funds in Asia, just through their website, contact us links, which of course resulted in nothing. But my CVs also went through to a few investment banks, and I ended up with a job with Citi, covering Pan-Asian equities and also their global hedge fund clients. So that was my real sort of kickoff in finance at a large bank. Did that for a few years, and then when GFC came, Citi suddenly became a very, very different place. A lot of the entrepreneurial minds left. There was sort of a civil service mentality to a certain extent. And, I knew that was time for me to depart and, start something. I did my grad school at Stanford, and if you don't do a startup, you've not studied at Stanford, basically. So I left in early '09, and with a few other partners, we started a boutique brokerage firm covering fund managers who were interested in really solid research-driven input and making money in Asian markets, basically. That was a phenomenal experience. We grew extremely quickly. Markets recovered, all of that. And 2 years later, we actually exited the business. And for me, I think I joined that firm when I was 25, 26, and kind of saw it scale very rapidly, saw the exit, kind of was part of the DD team and discussions. All of that was really interesting for me. Along the way, we even acqui-hired another team. So brilliant experience at a good, fairly relatively young stage in my career. And then I had to work with the new owners of the business, growing it further. They bolted on certain businesses. I also saw how M&A transactions don't always deliver the results that they are set out to deliver. So saw that side. And around 2014, when my earn-out obligations were well done and dusted, I started thinking about what's the next chapter for me. The first thought was to start a family office for myself and my parents in Singapore. Singapore, as you would have read, is becoming sort of the destination for family offices now. But about a month into it, I realized that I'm going to be bored out of my mind running a family office because, you don't do much most of the time. So I kind of, went back to my roots, which was technology, the multiplier effect that technology brings to finance, and also thinking about some of the structural issues that were facing the sell side, buy side business models. And we felt that, this was sort of right around the time of Anthony Jenkins at Barclays, and there was talks about the death of the universal banking model. Basically, what that meant was banks had become very large, very bloated. They were trying to do everything, and that was just not going to work. There's all sorts of stewardship risk when you're running a very complex business. And the idea was that more and more banks will need to figure out what they want to really specialize in and focus on those services. And other players will focus on other services. And I thought that, around that time, we had a very strong belief that no one institution can have a hegemony on all the talent, all the expertise. You can't confine all the expertise to the glass walls of an investment bank, as we were calling it. So we felt that there would be a very special place for a decentralized research network, which is institutional quality, extremely compliant with all the regulatory needs, but at the same time, brought a shared services platform to analysts who wanted to build and scale their own research businesses, and have the same distribution, if not better distribution, than what the banks offered to the top analysts. And that's where the idea of Smartkarma came about. And I also had a very selfish motivation here because I felt that there was a fragmentation of assets happening as well. Instead of giving money to a fund, more and more people wanted to sort of dabble and manage their own money. They were relatively self-directed, but they didn't have good tools available. They didn't have good sources of information available. And a lot of players were trying to focus on the data layer. How can we build good charting systems? And, everyone talks about disrupting Bloomberg. Like, there was a lot of all of that happening. But the real white space to me was the layer on top, which is the insight layer. What do you do with that data? Because data would get commoditized very quickly, it was obvious. But it's the insight layer where I think you can add a lot of value. And that's how Smartkarma started. Sorry, very long introduction, but hopefully that helps.
Perfect.
I think you also wanted to know where Smartkarma is today. So just again, very, very quick one on this. So Smartkarma today, I would say, is sort of, we've crossed our teenage years. We're a young adult as a business. And what that means for us is that we fully built out most of the infrastructure layers that we wanted to build from a tech perspective. And we've also fully built out the end customer segments that we wanted to build. But of course, we've not scaled them at all, So we're scaling up these segments. And what are these three segments for us? So the three customer segments for us are institutional investors and individual investors. So we call these investors. Corporates is the second one. And of course, for us, we see research providers also as our partners or our customers. So our network now has a great catchment of research analysts who are using our platform to distribute and monetize across institutional investors, corporates, and private wealth. Okay, back to you.
Oh, man, a perfect answer. I love it. Thank you so much. One thing I'm just curious about there. So your first startup, booming success. The second time around, was there anything you done differently, or how did you approach it the second time around?
For sure, we're very different. And I mean, I guess to use a sort of a very FinTwit analogy, the first startup was a trade. It was always meant to be a trade. I remember speaking with some of our founding partners at that time. We were staring at the APAC price to book chart. We started the business when Asia price to book was like 0.4, like below 0.5. And the idea was that we're going to sell out once it crosses 1 times price to book. So it was a mean reversion trade expressed through an operating entity, which we own a stake in. Smartkarma, on the other side, we're building this as a capital markets utility, as an infrastructure layer that will always exist, whether or not we are the ultimate owners in a few years' time. But you will not get rid of this decentralized network of talent. And hence, it's a very, very different gameplay. It is, so this is more an investment with a much larger, longer payoff over time, but also a significant upfront investment in order to capitalize that sort of tail end of the DCF, that terminal value. So yeah, in that sense, very, very different. Also, you know, the market conditions, the regulatory environment is extremely different. I don't think I would want to build a brokerage again, given some of the pressures we're seeing on trading commission rates, the rise of electronic trading, etc. However, we feel that the sell side model will evolve very, very quickly. There's a lot of unbundling of services happening. And that's again where we have positioned Smart Karma as somebody that anyone can use, whether you're on the sell side, buy side, you can come together and find value in this network to serve end customers.
Yeah. And like you said with Smart Karma, there was an investment. So it was obviously a lot of work up front. I've got it here. So you incorporated late 2014, was it? Sorry. Yep. Late 2014. 2015, you spent the majority of the year in idea, prototyping, proof of concept, and then you launched in 2016. So especially for 2015, what did that look like that whole year there?
Oh, the honeymoon period, really. I think there were a few profound issues at that time in the market. So when it comes to research, it's I find it very ironic that we're in the business of pricing risk, but if you go and say what's the price of research, nobody knows. And I think 2015 was a year when we really dug our heels in and said, if we really want to fundamentally change and have a lasting impact, we need to answer this question: how do you price research? And that was not straightforward because I felt the ecosystem was not fully ready to answer that question. And we found the answer eventually in other new media businesses, businesses like Spotify or Netflix. What they had figured out was that the scarcity in the value chain is actually the time of your user. And how that user decides to allocate their time is essentially the answer to the question of what the value of any particular piece of content is to them. And we said we're going to apply the same principle to research. Can we come up with a way to defining the value add of a piece of research and using that to allocate subscription dollars and bring huge efficiency? And as you can imagine, there's a new concept. The market was sort of not fully on board with it. So 2015 was a year when we had a lot of conversations with thought leaders within our ecosystem, and debating, discussing, validating our own assumptions before committing too much to tech capex and so forth.
Yeah. And even when starting out, was it sort of the chicken and egg problem with getting the writers to provide that insight and research, but also getting people to pay up? Like, how did you balance that and approach that when you started?
That's what we thought. But then, we were speaking to one of our investors, early investors, and they said something which was actually very useful. They said it's actually never a chicken and egg. Whenever you're building a network, supply should come first. That's it. They're like, you can't expect anyone to pay for something where there is nothing in there, right? So you need to pump prime, you need supply, and so forth. So that, at least strategically as well as operationally for us, that sort of brought clarity to what our focus should be. And hence, for that period from late 2015 all the way, the next 2 years was building the supply side of Smart Karma.
Yeah. And then do you approach and even change how you attract writers? Like, is there anything you wish you knew at the start about attracting insight providers that you know now?
Again, the struggle for us was that, at least in Asia, the independent research community just did not exist. There was no reason for it to exist historically because investment banks were doing well. If you were a top analyst, you graduated, you found your job there, you got paid very well, you stayed there till you retired. That was it. In US and Europe, of course, the IRP, which is the independent research provider market, had been growing for many years. But so the challenge for us in the early years, and I don't think we could have done it any differently, was how do you incept that ecosystem? Both in terms of incepting the idea in people's minds, but also very tangibly in terms of economics. And we didn't want to do what the Ubers or those large B2C businesses did, which is crazy amount of subsidies which were not really sustainable. So we wanted to take a slightly slower path. attract those people who had self-selected an entrepreneurial pursuit. That was also very important. It's very, very easy to give a large guaranteed payout and attract anybody, but they may or may not be entrepreneurs. So, a lot of this was just coming to terms with what is the right trade-off that we're happy with between a sustainable growth and unit economics, I guess. And that's what we did. Now, sort of fast tracking to where we are now. The main thing that we have now, which we did not have at the beginning, is data. We've got an incredible amount of data that guides our decision making on what sort of analysts or research firms are going to do well on the platform. And that helps us make better ROI calls on how we onboard new talent and grow it. And I think the end customer base benefits immensely from it as well, because the density of quality on the platform is maintained, or keeps growing as a result of that as well.
Yeah, so curious, if you're allowed to answer this, what insight providers do well on the platform? Like, what are the, yeah.
Yeah, it comes down to, I guess, three vectors. The first is what we call dollar density. What we mean by that is analysts who are focusing on areas of the market where there's a large amount of dollar value focused on them. So there's enough eyeballs and attention, right? That's obvious. But the other two are sort of counter acting. The second one is differentiation. And by differentiation, we have a definition of differentiation, which is don't try and do something that Wall Street can do better than you, or can do it at all. So people who are trying to do stuff that banks inherently can't do is great from a research perspective. It seems quite obvious, but they are the biggest competitor out there in the world of research. So if you want to make a way into research budgets of larger institutions, at least, doing something that is additive makes sense. And the last part is data driven. This is really interesting. You see, when you're a smaller research firm, the real scarcity again is your time. You want to do things that are scalable. And we feel that a data-driven, framework-based approach to research allows you to scale your product. And it also allows you to create differentiated segments and layers in your product, i.e. your upsell curve. Without having that upsell curve, I do not think you build a strong business. And I think that's the problem that a lot of newsletter writers are facing at the moment. What are you upselling to? Whereas if you think about, let's say, investment bank research, they're upselling their ECM transactions, right? So in the same way, I think data helps unlock those layers and that scale. So again, differentiation, being data driven and focusing on dollar dense niches in the market makes a lot of sense. So that's our framework.
Yeah, awesome. I appreciate you sharing that. And for insight providers as well, so feel free to correct me if I'm wrong, but it's based on merit-based compensation. So they get paid on overall engagement, collaboration. How do you orientate Smartkarma to not be a race to the bottom where engagement bait wins? Like, how delicate is that to manage, and what's the approach?
This is one of those questions which I think will always be a work in progress at Smartkarma. But first of all, when we talk about the services that our providers provide to our end customers, we try and break them down into these layers. So the base layer is what we call the written research that goes on the platform, that is available to any user who signs up to our platform, right? The compensation for this is based on what we call quantified value add, or QVA. In essence, it is a data-driven way for us to measure who's driving the most engagement on our platform. And the metrics have to be smart enough to, compensate for things like clickbait, as you mentioned. And we're dealing with a lot of very smart people in the room. So, we definitely have to keep improving this process, this algorithm, to ensure that, nobody games anybody else. It's a safe environment for everyone. But on top of that, some of the other services that we've built are very different. So, we above this platform layer, we have the premium layer, and the premium layer is meant for specialists. So to give you an example, let's say you're an Australian biotech, emerging biotech company's specialist firm, right? Now, you might be writing content that is of occasional use to a lot of people, to a long tail of people. Now, that's what the platform layer is for, to promote your discovery to everybody who might find it useful once in a while. And for that, you get a percentage, a sliver of their total subscription pot across a long tail. But then there will be a smaller subset of users on the platform who are your super fans because all they do is invest in Aussie small cap emerging biotech. They won't be happy with just what's on the platform. They'll want more. They'll want to speak to you. They'll want access to some of the data that goes behind your modeling. They want, blah, blah, blah. That's the premium tier. It's a subscription that sits on top of the platform subscription. So how do you upsell that in an inbound manner, leveraging platform tech, right? Then adjacent to that, especially with our corporate network, there might be bespoke research services where corporates would start recognizing you as a thought leader in that Aussie emerging biotech space and say, hey guys, could you help us as consultants on a particular project? Or could you provide us a bespoke research service on an ongoing basis? So again, all of that is not linked to QVA per se, because those are dedicated subscriptions sold to your super fans that we have discovered through that platform layer at the bottom. And there's one last piece of monetization, which is really fun. And this, we were really inspired by the strategic decision that Netflix took to kind of be a little less asset light and start producing its own content under the Netflix Originals banner, right? And we thought very, very hard about it, and we felt that they're doing something extremely counterintuitive but smart. They were literally, in my opinion, they were playing the monetary cycle. When interest rates were low, they were borrowing money and they were using it to build a great repository of content, which had a high shelf life. And for us, we started thinking about something similar. So we rolled out Smartkarma Originals, and we also rolled out, under that Originals program, lots of different things. So the first is sort of masthead, thematic, long shelf life content, fine. But we also rolled out something called rapid responses. This is quite fun, where we use platform discovery and data to figure out content that might be missing on the platform, but it is really important for the platform at that specific period of time. So we issue out RFPs essentially on an intraday basis for such content. And again, all of this process is fairly automated, but it's a really high ROI effort on our supply side. And again, we've got physical roadshows, engagements, essentially sort of taking a lot of that corporate and analyst access as well and building it as a way for analysts to monetize their services.
Yeah, interesting. And one tidbit that caught my interest as well was that Smartkarma does not require exclusivity for content or research published on the platform unless otherwise agreed. So the content or research must, however, not be accessible elsewhere for free. So how did you come to that decision? Because I don't think it's that common.
Our initial target market for supply were boutique research firms who were specialists in specific areas. I think it would be rare to find one such firm that did not already have some anchor customers. And we couldn't go to these guys and say, sorry, abandon your customers. So by definition, it was hard for us to ask for exclusivity when going to existing providers, right? The other thing was that we also did not want to create unnecessary friction in terms of that onboarding process. We were already trying to inspire these guys to give up on their own pricing models and rely on our pricing model. And now we didn't want to create just one more sort of point of difference of opinion. So we said, look, you want to have your own clients, you already have your own clients, that's fine. Over time, we'll prove ourselves to be your most dominant income channel. And if we do that, it's all good. And actually, that's been the direction of travel. So over the last few years, we've rolled out other programs. So I think about 18 months ago, we rolled out a program called One Team, which was meant, it was an invite only program for some research providers where we reverse onboarded their customers onto Smartkarma as well. Uh, because it made a lot more sense for their customers to access their content and services through our platform, blah, blah, blah. And it made a lot more sense for these providers to, let us handle the whole back end, the operations, everything, compliance, yada, yada, yada. And that's been a really successful program actually for these providers. Most of them, there's been one or two exceptions here or there, but that's been great. But it came after some time when enough trust had been built. And I think the other thing is there is a lot of content now on Smartkarma that is by definition only exclusive to Smartkarma. All the discussions, all the real-time communication that's happening, that's not really transported out. So that's quite unique and native and exclusive. And over time, that's sort of growing as a percentage of the pie.
Yeah. And given you operate in a field with such large legacy players, and even now you have a partnership with Bloomberg, I saw. So what did people think about Smartkarma when you started it? Like, how has it been navigating that field of, very large established players?
Okay. Well, one correction: we don't really have a partnership with Bloomberg.
Okay, sorry.
We work very closely with a lot of these firms, and yes, a lot of large firms are our partners. I think the answer is really simple. We try and help everybody. We are trying and helping the whole ecosystem graduate to a much better business model. So if you look at banks, the problem with the bank research departments today is that it's an enormous amount of fixed cost. Enormous. One of our customers, which is a large sell-side institution, their fixed cost of research in Asia alone is about $90 million. So on the 1st of Jan, they're down 90, and they have to plow their way back against that negative 90. Smartkarma, on the other hand, is a variable cost model. Hence, we know that over time value will migrate to a model like us. So can we bring that capability to such players? Yes, easily. A lot of these players over time are whittling down their own internal research costs in specific areas. For example, Japan's a really expensive market. So they might say, hey, let's shut down our team in Japan and plug in Smartkarma as a third-party research platform that our customers can enjoy in that market. Hypothetical example. But again, so long as value is migrating towards us and our positioning against the incumbents is very friendly, we're trying to add value to everybody. It makes it very, very easy for them to start using us rather than feeling threatened by us. And I genuinely believe that's the way for a lot of firms like ours to grow. Just be a utility that everyone can benefit from.
Yeah, couldn't agree more. Same thing goes with life and personal relationships. Yeah, just add value.
Yeah.
So given that Smart Karma is a network that connects three core audiences in capital markets: investors, insight providers, and corporates, how do you balance the needs of all three? Is there one that requires more attention than others?
The first thing is that the main thing that glues everybody together is insight. Everyone is, it sounds funny, we're content rich, insight poor. So as long as we can not compromise on the sort of the quality of insight, you're fundamentally adding value to everybody. You might not be making everybody happy with that insight, but you're still adding value. So that's our number one focus. The second big focus for us is reducing friction through technology. All these three constituents, investors are investing in corporates, research providers are writing research on corporates. Corporates want to speak to both research providers and investors. This is not an ecosystem we've created, it's an ecosystem that already exists. But the communication amongst the constituents of this ecosystem has had a lot of friction. And there's been too many intermediaries with, really convoluted, complex business relationships, and compliance processes can often make it even more difficult. So that's a great tech problem. That's a great platform problem. How do you reduce the friction? So I'll give you a really simple example. Do you know that 90% of investor relation teams do not have their contact details on their own websites.
I don't even know.
Yeah. So we did a survey in our early days before we were building out the corporate side of the business. Now, investors are meant to reach out to companies with questions but how do you contact them? Right. Simple issue. And let's say the email address was there or a phone number was there. How long would it take for you to get those answers back, if at all? And also on the other side, for investor relations teams, it wasn't easy to answer, hundreds of questions from, small retail shareholders, for instance. Great little problem, right? So, using our platform, first of all investor relations teams that are onboarded are directly connected via chat to our users, at least our premium users. We've also built chatbots for them to put on their own websites, which can answer all the basic, FAQ type stuff real time, So that's just a really simple example, right? How you can bring corporates and investors closer together. But I think that fundamentally changes how these interactions happened. You no longer require a broker to set up a roadshow. You no longer require, the roadshow product can be can be a DIY product on Smartkarma. You've got an events engine, you can set up your event, you can share, it's a Zoom enabled sort of extension to our platform, but you can host your own online roadshow whenever you want to. So removing a lot of those layers of friction, I think keeps everybody happy at the same time. And I think the third and final part here, and this is a really important part and it's part of our moat, is trying our level best to do everything in a compliant way. When you start building compliance layers on top of your products, it slows growth down. But it creates an ecosystem that is hopefully more durable and safer. We've seen things go horribly wrong in other ecosystems just in the last month because this part was a little bit deficient. But I think if you build it in a compliant way, you're constantly trying to remove friction and you're trying to add value through insight. I think that's what we can do as a platform to keep everybody happy.
Yeah, perfect. And this could be a very straightforward question, but I was planning to ask it at the start, but we sort of just got stuck in. So why decide to incorporate Smartkarma in Singapore? Is it the compliance easy? Obviously, it's a financial hub, but given you have like a history with India, you studied in the UK, was Singapore the only option ever, or how did you come to that?
No, we actually sort of started with a blank sheet of paper. We were definitely thinking, could it be London? Should it be New York? Whatever. And there were a few reasons for Singapore. The first one was if you think about the corporate and the institutional side of our business. Pretty much every large fund manager has some sort of a presence either in Singapore or in Hong Kong. And again, I'm scoping this to those that are interested in Asian markets because, we started off as Asia only. So you could definitely tap onto most Asia-focused institutional investors by being in either one of those markets. Second, if you looked at the private wealth side, Singapore has the highest number of millionaires per capita, but not just that. 50% of the world's population is within a 6-hour flying radius, i.e., in the same time zone. Now, this population is not only growing the fastest when it comes to wealth, but it's also the biggest base. So never in the history of the world have you seen so many new millionaires being formed at the rate at which we're seeing now in this, this addressable market. So it made sense for us to be very close. And then, Singapore is very, very well known for being a hub for professional services in the region, right? That's been the human kind of the human resource that where Singapore has tried to add value. So we thought of research as just yet another professional service. If Singapore can have great lawyers and great accountants, it can also have great research analysts, not just based here, but at least virtualized via Singapore. Yeah, and that's why Singapore. And in the case of my last startup, we had started it in Hong Kong and we had expanded it into Singapore. In this case, we sort of decided we'll start it here.
Interesting. And given you originally started off focusing on Asia, but there's been the recent expansion into Europe, What was the approach there, and was there any growing or expansion pains you didn't anticipate?
A lot, actually. I mean, I think we made a few mistakes with sort of our globalization push. Our hypothesis was that you need to have presence on the ground in international markets to speak to some of the customers that were based there. Uh, I think we went a little bit wrong with how we prioritized some of the markets. We tried to do two or three of them at the same time. In hindsight, we should have sort of sequenced it serially. And what that meant was it was a huge drain on management bandwidths. And also, it made our organization a little bit more complex. We had country managers, but also functional heads. And, you know, the organization became a little bit more inward focused, spending too much time in internal meetings than outward focused. And you know, that experiment lasted about 18 months to 2 years, but I think we had enough evidence by that time that we had to unwind some of those things. So we did that. We again made the organization a lot simpler, a lot more focused, and we started thinking differently about our offshore presence in two ways. The first is, as I was mentioning, anyone who is serious about Asia as an institutional investor will have some presence on the ground here anyway. So our hypothesis was a little bit wrong at that time in that sense. The second thing was that we realized that instead of investing into human capital in those markets, we could invest into technology that makes a lot of our revenue more inbound than outbound. And we started doing that. And the last 12 months or 18 months we've reaped enormous dividends of that. Almost 70% of our revenue is coming through inbound channels now. So it was still an investment, but it was sort of, let's invest in that tech stack and SEO and all of those things, as opposed to putting sales guys on the ground in some of those markets. And now, given that we've done those investments, we still have people who are focusing on those geographies, but they don't necessarily have to be based there, but B, their role has changed from being outbound to being somebody who handles that incoming inquiry. So that was our learning. And also, it's very, very important that we stick to our roots in Asia from a focus perspective. But we made one slight change. Instead of being Asia only, we became Asia first. So what that means is we will cover Tesla because China is 105% of the net profit these days for Tesla. But we will bring the Asian perspective to it, all right? And that still adds value to investors sitting in the US who have Tesla and their US mandate. But there'll be a differentiated angle that we will bring. What we will not do is suddenly start covering Wells Fargo and so forth, where it's a little bit hard for us to prove why we are adding value.
Oh, perfect. And what's the plan now, I guess, for Smartkarma? Where are you guys heading towards now? Where do you think you're going? Where do you want to go? Yeah.
So, as I mentioned, we've got these 4 paying customer sets. We've got institutional investors, we've got corporates, we've got private wealth. Institutional investors is, I guess, our most evolved segment, and we've got a great playbook. And we're going to continue to keep premiumizing this segment, which means more and more extremely differentiated premium subscriptions that sit on top of that platform access. Our corporate segment came second. It's grown very, very nicely this year. I think we've crossed 2,500 corporates, but that number could 10x over the next 2-3 years. So we want to continue to double down on what sort of worked over the last 12 to 18 months and continue to improve that connectivity between corporates and the other two sides of that network. Private wealth is our youngest segment. We kind of only launched it in January. So, and the idea with private wealth for us was, how do you now start to democratize the tail? So we're premiumizing the top. How do you democratize that tail? But you do it in a completely inbound, 100% automated DIY funnel and a very robust funnel. And we're having great success with that funnel and also in B2B2C partnerships around that funnel. So I think with private wealth, it's just about extreme amounts of scale. And as you've seen, markets were not very conducive to scaling a private wealth product in the first part of the year. But now I think we're really busy in a lot of conversations around scaling that. We're very excited to see private banks who have been very rigid in their compliance structures and suddenly sort of changing their approach. I think we've de-risked the Smartkarma network sufficiently as a brand and a product that these guys want to now use us as part of day-to-day business. So really scaling the size of the private wealth thing, but doing it in an extremely inbound manner and channel partnership approach is what we're going to do. So that's all about organic growth. At the same time, I think this soft patch in markets has strategically opened up tremendous opportunities for us. A lot of incumbents are reviewing their own business models. There's a lot of cost pressures. We're also seeing some very, very interesting adjacent companies, startups, smaller firms that have built some very unique services that sit right next to Smartkarma, and we're in conversations with them. So, there might be some very interesting developments over the next 12 months on that inorganic side as well. But, as long as we don't forget, right, that we're trying to build, core capital markets utility that adds value to everybody, and we're going to do it in a very sustainable way. We're not going to get caught up by blue skies and, those crazy B2C hockey sticks. I think we're fine.
Yeah, awesome. And is there anything else we haven't covered today that's consequential about the future of Smartkarma? Anything else you want to touch on or talk about?
Well, we haven't spoken about your podcast name. It's a great name, I think, actually. I think compounding is such an important principle at Smartkarma. We talk about daily compounding in terms of what we do in our processes internally. But I think also curiosity. I think curiosity is at the heart of good investing. So I think that's fantastic. And I just wanted to sort of comment on that more than anything else. And lastly, I kind of also wanted to say, our private wealth product, if anyone wants to try it out, and you don't want to pay the $50 fee, you want to give it a simpler try, reach out to me or reach out to Smartkarma via our Twitter accounts. We'll happily oblige in the spirit of the festive season, if nothing else. But look, at the end of the day, we feel there is a significant amount of money to be made in some of these Asian markets. They are deep. They're getting broader by the minute. There's tremendous amount of market cap that is going to get listed over the next 2-3 years. So there's enormous value to be part of the network in whichever way. You could be an investor, you could be a research provider. Do approach us, and we would, very much welcome everyone.
Awesome. Thank you so much.
Thank you so much, Raghav.
Enjoyed every minute and learned a ton. So yeah, thank you so much.
Thank you so much.
Oh, thanks, Kalani. And Merry Christmas to you and all the listeners.
Yeah, and to you and your family as well. So yeah.
Thanks very much. Take care, buddy. Bye-bye.